So, Warren Buffett once said that for most investors, the best investment is a simple, low-cost S&P 500 index fund. And he's right. Over the past decade, these funds have absolutely crushed it, delivering 14% annualized returns while most active fund managers fail to even match the market. But here's what gets interesting. There are now 3 dominant S&P 500 funds fighting for your money: FXAIX, VOO, and SPY. And on the surface, they all look identical. Same 500 stocks, same strategy, same double-digit returns. Yet one of them charges 6 times more in fees than the others. Another one could save you thousands in taxes over your lifetime. And the third one is secretly the most powerful trading weapon in the entire options market, moving billions of dollars every single day. So if these funds all track the same index, why do the differences matter? Well, picking the wrong one could cost you tens of thousands of dollars by retirement, while picking the right one could unlock opportunities most investors don't even know exist. So let's start with FXAIX, the Fidelity 500 Index Fund. This is a mutual fund that tracks the S&P 500, and it's available with 0 transaction fees at Fidelity brokerage accounts with no minimum investment in many account types. Now the first thing that jumps out about FXAIX is the expense ratio. Just 0.015%. To put that in perspective, for every $10,000 you invest, you're paying just $1.50 per year in fees. It's not just cheap, it's the cheapest of these 3 funds by a meaningful margin. But here's where things get interesting with the recent performance. FXAIX has actually been slightly outperforming its ETF competitors. Over the past year, FXAIX delivered a total return of around 16 to 17%, and over the past 10 years, it's averaging roughly 15.29% annualized returns. Those are nearly identical to VOO at 15.26%, but the slight edge in dividend yield, FXAIX pays out about 1.1 to 1.3% versus VOO's 1.1 to 1.15%, means you're collecting a bit more income along the way. And if we dig into the numbers from Portfolios Lab, FXAIX shows a Sharpe ratio of 0.78 versus VOO's 0.77. Now that's an incredibly small difference, but it suggests that dollar for dollar, FXAIX has been delivering slightly better risk-adjusted returns over the past year. The Sortino ratio, which measures downside risk specifically, also favors FXAIX at 1.21 versus VOO's 1.20. Now, some of this performance difference can be explained by those lower fees compounding over time, and some of it is just timing and reinvestment effects. But what really matters for most investors is the structure. See, FXAIX is a traditional mutual fund, which means it trades once per day at the closing net asset value. There's no intraday trading, no bid-ask spread to worry about, and you can set up automatic investments that purchase fractional shares down to the penny. If you're someone who wants to dollar-cost average $500 every month automatically, FXAIX makes that dead simple, especially if you're already banking with Fidelity. And here's a detail that most investors miss. On November 10, 2025, FXAIX updated its diversification policy to allow it to operate as non-diversified when necessary to track the index better. Now that sounds scary at first, but this is actually just a technical accounting change to deal with that concentration issue we'll talk in a bit. Because the S&P 500 itself has become so concentrated in mega-cap tech stocks, Fidelity needed the flexibility to hold those same large positions without violating old diversification rules. So FXAIX works best for investors who want the absolute lowest fees, who are investing through Fidelity, and who prefer the simplicity and automation of mutual funds over the flexibility of ETFs. But that leads us to our second fund, VOO, the Vanguard S&P 500 ETF. This is where things start to get interesting for a different type of investor. VOO launched back in September 2010, and it's grown into a behemoth. We're talking $1.46 trillion in net assets as of December 2025. That makes it one of the largest ETFs in the world, and for good reason. The expense ratio sits at 0.03%, which is double FXAIX but still incredibly cheap by any standard. And despite that slightly higher fee, VOO has delivered nearly identical long-term performance, around 15.26% annualized over the past decade, with recent one-year returns around 17.56%. But here's where VOO really shines. Tax efficiency. See, because VOO is structured as an ETF, it has some built-in tax advantages that mutual funds like FXAIX just can't match. When other investors sell their shares of VOO, those transactions happen on the secondary market, meaning they don't create taxable events inside the fund itself. With mutual funds, when a bunch of investors pull their money out, the fund manager has to sell stocks to raise cash, and those sales can trigger capital gains that get distributed to all the remaining shareholders. This is especially valuable if you're investing in a taxable brokerage account rather than a retirement account. Over decades, those avoided capital gains distributions can save you thousands in taxes that you would have owed with a mutual fund. And then there's the flexibility. VOO trades throughout the day just like a stock, which means you can buy or sell at any time the market is open. Want to add money during a midday dip? You can do that with VOO. Need to implement tax loss harvesting strategies at the end of the year? VOO makes that way easier. Plus, VOO currently holds about 503 stocks, with a recent holdings update in late November 2025. And because Vanguard has such a strong reputation for low-cost index investing, basically the company that pioneered this whole space, you know you're getting best-in-class index tracking without any surprises. So VOO is perfect for investors who want portability across brokers. Maybe you're not locked into Fidelity, who value tax efficiency for taxable accounts, and who might want the flexibility to trade intraday or implement more sophisticated tax strategies. Now before we compare these three head-to-head and tell you which one to pick, there's something critical we need to address that applies to all three of these funds, a hidden risk that most financial advisors gloss over when they're recommending S&P 500 index funds. And once you understand this risk, the decision of which fund to choose becomes a lot clearer. According to research from Charles Schwab, by early 2025, the top 10 companies in the S&P 500 now make up nearly 40% of the index. That's a higher concentration than we saw even at the peak of the dot-com bubble. And here's the kicker. Technology stocks alone comprise 41% of the S&P 500 index, the highest concentration we've seen since the tech bubble burst. So what does this mean in practice? It means that when you buy FXAIX, VOO, or SPY, thinking you're getting broad diversification across 500 companies, you're actually making a massive concentrated bet on a handful of tech giants. Nvidia, Microsoft, Apple, Amazon, Meta, Alphabet, and Tesla. And this isn't inherently bad. These are phenomenal companies with real earnings and real cash flow. But the S&P 500 could sway and move profoundly based on just a few names. This opens the door for investor exposure to what's called concentration risk, which could make you prone to violent swings in the market. We've seen this movie before. In the 1970s, the Nifty 50 stocks were considered bulletproof, and investors paid sky-high multiples for perceived quality and growth. But when inflation surged and growth slowed, many of these stocks collapsed, dragging the broader market down with them. In the late 1990s, the dot-com bubble saw tech stocks dominate the S&P 500, and when it burst in 2000, the Nasdaq lost nearly 80% of its value. Now I'm not saying we're in a bubble today. The companies driving today's concentration actually have strong fundamentals and earnings, unlike many of the dot-com era stocks. But the risk is still there. If one or more of those top holdings falter, it will have an outsized impact on your overall returns. According to data from TD Asset Management, the top 10 S&P 500 stocks now account for nearly half of the total volatility in the index. So even though you own 500 companies on paper, your actual risk exposure is incredibly concentrated. The point isn't to abandon these funds. They're still excellent long-term investments. The point is to understand what you actually own, and to make sure you're not putting all your eggs in one basket by assuming the S&P 500 is automatically diversified just because it has 500 names in it. Which brings us to SPY, the SPDR S&P 500 ETF Trust. And this fund has a split personality that we need to talk about. SPY launched in 1993, making it the grandfather of all ETFs. It literally created the modern ETF industry. With $700 billion in net assets and total returns above 2,600% since inception, this isn't some fly-by-night fund. SPY has survived the dot-com crash, the 2008 financial crisis, the 2020 pandemic, and delivered around 10 to 11% annualized returns through it all. But here's the problem. SPY charges 0.09% in fees, 6 times more than FXAIX. On a $100,000 investment over 20 years, that's $13,500 more in fees for the exact same S&P 500 exposure. So why would anyone choose it? The answer splits into two camps. For long-term investors, if you bought SPY years ago and you're sitting on massive gains, you don't necessarily need to sell it. The tax hit might outweigh the fee savings, and SPY's institutional staying power and tight index tracking are rock solid. But if you're investing new money today and you're just buying and holding for retirement, there's no reason to pay that premium. FXAIX or VOO give you the same exposure at a fraction of the cost. For options traders, this is where SPY becomes a different beast entirely. SPY averages 8 million options contracts traded per day. That's 10 to 20% of the entire options market. This extreme liquidity makes SPY the go-to vehicle for anyone using options strategies. According to TradeStation data, SPY's bid-ask spreads are incredibly tight, transaction costs are minimal, and you can move large positions without slippage. State Street Global Advisors research shows these liquidity benefits become even more pronounced during market stress. When everyone's panicking, SPY remains tradable. And it's not just day traders. Retirees sell covered calls on SPY shares for monthly income. Portfolio managers buy protective puts to hedge against downturns. Institutions use SPY for rapid rebalancing. The 3 weekly expirations, Monday, Wednesday, Friday, give you flexibility you won't find with most securities. So here's the bottom line. SPY only makes sense for new money if you're actively using option strategies or need that extreme liquidity. If you're selling covered calls, buying protective puts, or implementing multi-leg strategies regularly, the 0.09% fee is worth it. The tighter spreads and lower transaction costs actually save you money. But if you're just buying and holding, you're paying for a Ferrari when you need a Honda Civic. So now that we've looked at each fund individually, let's put them head-to-head and see how they actually stack up. Before that, if you're already finding this video valuable, give it a thumbs up and consider subscribing to the channel. While this is free for you, I spend a good amount of money to do the research and bring such valuable content. Alright, let's compare these funds together. Over the past 10 years, all 3 funds have delivered nearly identical returns. FXAIX is annualized at around 14.43%, VOO at 14.46%, and SPY at roughly 10 to 11% since its 1993 inception, although SPY's longer track record includes some brutal bear markets that bring down its average. If we zoom in on recent performance, the year-to-date numbers as of late 2025 are remarkably close. FXAIX is up around 17.51%, VOO is at 17.19%, and SPY is sitting around 14 to 17% depending on the exact measurement date. The real differences show up when we look at yield and fees. FXAIX's dividend yield sits at about 1.4 to 1.7%, VOO comes in at 1.1 to 1.3%, and SPY is lowest at 1 to 1.1%. Now none of these are high-yield dividend plays. Most of your return is coming from price appreciation, not income. But if you're in retirement and living off dividends, that extra 0.3 to 0.6% yield from FXAIX could make a difference. If we look at a $10,000 investment over the past 10 years with dividends reinvested, FXAIX would have grown to roughly $39,000, VOO would be sitting at about $38,800, and SPY would also be in that same ballpark. We're talking about differences of a few $100s over a decade on a $10,000 investment. Meaningful, but not life-changing. So with all of this information, how do you actually decide which fund to pick? Let's break it down by investor type. Choose FXAIX if you bank with Fidelity and want seamless integration. Prefer automatic investments and fractional shares. Want the absolute lowest expense ratio possible. Are investing in a retirement account where tax efficiency doesn't matter. Don't need intraday trading flexibility. Want that slightly higher dividend yield. Choose VOO if you want portability across any brokerage platform. Are investing in a taxable account and care about tax efficiency. Might want to implement tax loss harvesting strategies. Prefer the flexibility of intraday trading. Want best-in-class index tracking from Vanguard. Are okay paying an extra 0.015% for ETF structure benefits. Choose SPY if you actively trade options and need maximum liquidity. Use covered calls or protective puts regularly. Implement complex multi-leg option strategies. Need to move large positions with minimal slippage. Are a professional or institutional trader. Understand that you're paying for liquidity, not performance. Remember, missing just the 10 best days in the market over the past 30 years would have cut your returns by more than half. And if you want to keep up with these kinds of practical, data-backed investing breakdowns, YouTube thinks you're going to enjoy this video next. I'll see you over there.